The financial system is breaking down, and you're probably not ready for what's coming. Now, some of you may be ready. Maybe you've said, Neil, I've taken some of your finance courses. I'm in your Patreon, and I watch your monthly macro video. I'm ready. But I'm honestly say the majority of people are not ready for what is coming down the line. Now, we can go over some news and stuff today, but I really want to focus on, I made a ton of notes for you here. I spent all day just working on this, and I want to show you a comparison of some of the biggest things I'm seeing between sort of that 2008 period where we had the great financial recession and what I'm seeing today. So I want to do a comparison here. It's funny, I was speaking to a friend earlier who said, Neil, do not do that live. That is like the most complex video. No one can do this. So I'm just going to do it live. So we're going to go through it all. But if you want to see a couple of the news bulletins that came out today, I mean, look, global stock rout deepens as $500 billion wiped off AI chip makers. This was huge as to what happened, and if you're not aware, it was all around Palantir. It was our favorite, where is he? Here he is, The Big Short. It's going to be called The Big Short 2.0, I think, because his position was about $1 billion. I mean, it's pretty much 80% of his entire position, actually, he put in this. So let's talk about this a little bit then, and then we'll go into this big comparison that I've done for you. It's absolutely huge as to what I'm seeing. So 500 billion was basically wiped off the AI chip makers yesterday in one day. Now, markets are not going to open for about 45 minutes, so we don't exactly know what's going to happen today, but pre-markets, I'm guessing it's going to be pretty neutral at the minute. But so it wasn't just the US, by the way. It was South Korea, it was Japan, it was all sorts of markets just had a terrible day yesterday. South Korea dropped 6.2%, Japan hit negative 4%. It was crazy. Nvidia is one of their, actually is their supplier. Advantest dropped as much as 10%. TSMC fell more than 3%. It was just huge. And you got to remember that the bosses of Goldman Sachs, Morgan Stanley, they both said a correction is imminent and it could happen between now and the next 2 years. And they've said it's going to be a big one. And I think they are right in that. So what actually happened with Michael Burry then? If you haven't seen The Big Short, it's a movie. It talks all about that. And you probably remember back in the day, I talked about this and I said it used to be the CDOs, collateralized debt obligations is what they called them. And they were all AAA rated. Why were they AAA rated? Well, it's because if they didn't give this rating, they would go down the road to another ratings agency and they would then give this AAA rating, right? So it's all a load of nonsense. You can't really trust these ratings. So people were buying these bundles and thinking they were getting a great deal on it, and actually they were buying junk, and it all just came down. And then they basically made them illegal, these CDOs. So what did they do? And it's so funny. It's 2008. All this happened. 2025. A lot of the people that were around then, some of them will not be around now. Maybe they've retired. Some of the more senior people retired. Some of the legislators will have gone at this point. So what did they do? They've turned them not into these CDOs, but they've called them BTOs. So it was all made illegal, and yet they've rebranded into these BTOs, which is, I think it's Bespoke Tranche Opportunity it stands for. But be careful with this stuff anyway. This is the position we're in now. So yeah, as soon as he put this short position on, we just saw chaos happen. And there was a couple of, where is his, where is it here? Yeah, there's a couple of things he posted on X, which I looked at. But basically, you don't need to understand this whole thing here. All you need to know is all these AI companies are paying money to one another. That's basically what they are doing. And it's just a massive, massive bubble. Now, I'll give you the sort of counter to that, why it may not be a bubble. But Palantir did not do very well, let's just say that at the moment. So we'll see what happens today. But I want to go on to now the comparison that I've done for you, and it's quite a big one. So we'll start on that. And if you haven't yet taken my webinar that I mentioned on Monday's video, it is still available for you. It is free of charge. You can register and watch this 1 hour masterclass for you. It will teach you all about stock market investing, etc. So, okay, let's get into that, and the link for that is below in the description. Let's get into the comparisons that I'm seeing, which are very worrying to me between 2008 and today. The first one, I think, is the most obvious one. I've been talking about this for a couple of years here, and that is, if you remember, it was residential real estate back in 2008, and I said the next one is going to be commercial real estate. Well, let's look at the delinquencies here. The 2008 sort of peak, it was 10.7%, okay? This was 10.7%. Today it's 11.8% and rising, and that's not even the worst point of it. The office demand is actually lower structurally because you've got remote work, you've got hybrid. Buildings are long duration assets financed with debt that eventually must be rolled over, keyword rolled over. So what are they refinancing at the minute? It's around 6 to 8%. It's not the sort of 2 to 4% sort of rates that a lot of people might think it is still. It's not. So you're looking at 6% refinancing rates. And it's not just that. You're already seeing buildings selling for 50 to 75% markdowns in a lot of places. San Francisco, we did a video on that, Chicago, New York, etc. Good luck to everyone living in New York with your new mayor, by the way. Wow. You know, you can vote your way into communism, but you got to shoot your way out, as they say. So that is the main one I want to say first, is the big one. But the next point, though, is that there's just too much leverage built on an assumption that interest rates would stay low forever. And there is this big rollover taking place, which hasn't yet happened. It hasn't all rolled over, but it is. It's coming up. And a lot of this is going to collapse. So if you think in 2008 then, the Fed had a lot of room to cut interest rates. It's our third point. Today, there's a lot of constraints. Jerome Powell is very hesitant to cut rates. They did just cut rates by 25 basis points. But if you think about why they did that, it was more of an insurance sort of hedge with the tariffs and trade wars and everything else like that. So in 2007, it was a 5.25% rate, and they cut it all the way down to 0%. Now, you think what it is at the minute, they haven't got that sort of that same room. And if inflation comes back, it's going to be a big issue. Fourth point then is the bank exposure. And I don't know if you remember that video where I was in the snow that day, and I said, I think these banks are going to collapse in the next few days at most. I said they could even collapse while I'm recording this video. And then we had, 3 or 4 banks collapsed while I was basically editing and putting that video out. It was absolutely insane. So these regional banks, some of them are still way down. They haven't recovered from all of their losses since 2021. Small and mid-sized banks hold the majority of commercial real estate loans. They hold, so CRE lending, small and regional is 70%. The big money center banks is 30%. These are going to get hit big time, these small and regional banks. Number 5, corporate debt maturity. A lot of this corporate debt is going to roll over and mature in sort of 2020, from this year to 2027, a huge amount of it. So if you think a lot of these companies borrowed at, say, 3%, some of them, they're going to have to refinance now at 6 to 9%. So this is already visible in rising bankruptcies. We're seeing this a lot. Even the big ones, we just had a $12 billion bankruptcy, distressed credit levels, profit margin compression. You know, this is a lag effect that we're seeing. So these, let me see if there's anything else I want to cover on this point. Yeah, actually I can tell you a little bit more on some of this. So office occupancy as well was 95% pre-2020. Now it's 50% because of all the hybrid models and everything like that. Consumer delinquencies, credit stress, credit card delinquencies, so this is 90 days late. In that sort of period before, it was about 3%. Today, it's 5.4%. Auto loan delinquencies, again, 90 plus days late. It peaked at 5% in 2008. Today, it's 5.8%. The personal savings rate back then was 3.6%. Sorry, it was 3.26%. Today, it's 3.5%. This is near historic lows. Credit card debt in 2008 was 985 billion. Today, it's 1.14 billion. Housing market, remember we talked before about the, can't remember what it's called exactly. It's basically the income ratio. It's like your price to income of a house. So let me just throw a random example out. Let's say you want to buy a house for $500,000 and you earn $50,000 a year. And that means your ratio is 10 to 1. And some places are way, way above that. Well, in 2006, which was the peak, it was about 7x, so 7 to 1. Today, it's 7.6, so affordability is out the window. Mortgage rates also a lot higher today. And you're looking at double the rate as well, your mortgage cost per month. The corporate debt roller, a couple more, we may as well go through the more specific notes here. This 5.8 trillion is going to be refinanced at 2 to 4 times higher rates. And again, it's not 3% now, it's 6 to 9%. We also have some of the regional banks are down by as much as 80% from 2021. Government debt, 9.5 trillion in 2008. Today it's 34 trillion. The interest on that debt, 250 billion in 2008. Today it's 1.1 trillion. And coming back to the stock market, if we just focus on the S&P, we could talk about the Dow and the Nasdaq and everyone else, but just on the S&P here, the top 5 stocks are now 18% of the index return. The Magnificent 7 is 60% of the index return. What does that tell you then? So if you think about it, this system that we're kind of at the end of, really, it was really built for 0% interest rates. It wasn't built for the higher rates. And actually, I haven't got the chart here, but if you think of what the rates were like previously over the last 50 years, they weren't this sort of 0% rate that everyone thought, oh, well, that's it. Low rates are here to stay, 0% rates. They're really not, and now we're coming to grips with this. And that's why I think there's going to be a very heavy crash. It's going to be a massive economical crash. And it's not, and I travel a lot. And it's interesting. I've been speaking to so many people this week from different countries all over the place. And it's just interesting to me, the similarities with each country. Everyone is saying that spending's down, consumers are concerned, tourism's down. There's all sorts of things. Everyone's concerned at the minute. People are not traveling as much. And it's all of these telltale signs. And you can also feel it in your gut a little bit as well. Now, what else was there? Okay, we had a massive one that came out. This was from the Bank of England chief as well. It's 3 trillion US dollars, which is about 2.2 in British pounds. This is the shadow banking industry that's developed these bubble-like characteristics now. Everyone thinks this is going to cause a massive shock. Even Fitch has just come out as well, so that's about the 5th agency now, said this is going to be a massive shock. It's ballooned 50% just in recent years here. The IMF has also said that they expect a massive problem with this industry. We had as well, actually, let me show you the CAPE ratio. I think you'll find this quite useful just to help you this. Okay, so it's also known as the Shiller PE ratio, but I always say the CAPE ratio. If you look on your portfolios or your and how you do your analysis, you'll see it as the CAPE ratio, but it's called the Shiller after Robert Shiller from the professor, as it were. But you look where it is now. It's almost at 40, okay? Well, look where it was when we had other crises. Look at 1929. Obviously, it's different, slightly different now, but you look where it was there, 31.48. When we had the dot-com bubble, it got to 44. So this is only the second time in, well, history, since we can go right the way back, that it's breached the sort of 40 mark here. So the median on this, or the mean you can take either, is about 16. Well, the max was 44 in December of 1999. Look where we are now. It's telling us that we are in overbought territory. And honestly, I could show you loads of different charts. This is the MSCI World, the largest 5 stocks as a percentage. That was the tech bubble peak, right? So people that say AI stocks aren't in a bubble, okay, well, this is it now. This is it today. But just to give you the sort of counter to this as well, because I don't want to be sort of all doom and gloom here with it all, because I think you can make a lot of money in the markets. I really do. You've just got to know how to be careful with it, and you can really do quite well. But the longest one was the sort of dot-com bubble here, and that was 1,167 days. We had a 51% drawdown on the S&P. The global market crash was 874 days, and that was 73% down. I think that was probably the biggest one that we've actually had. But you look at the bull and bear markets. The blue is your bull market, and the bear is your in red here. Sorry, I should probably make it simple language for my audience. So your bull market is when it's rising, your bear market is when it's falling, okay? So you look, and you can see here that this is why it's worth dollar cost averaging in, and also knowing how to pick the right stocks, because over time it does pay to be in the markets. I wanted to read a couple of other points then, and this was, so Jamie Dimon just made a massive warning yet again, and he's warned about the AI bubble. But the Bank of England chief recently has just done a big announcement. He's put in a big, what would we call it? He's getting all the politicians together for this sort of emergency meeting. He wants to know how much exposure we have, sort of the UK has against this, because he thinks there's going to be a massive crash. There was an article on it actually. This was, if you want to look at it, this was the article. It was in the Standard where he talked about all of this. I'll go through a couple of points here. So here we are less than 20 years later, and the governor of the Bank of England, who in 2008 was a chief cashier at the bank, is very worried. He's told the House of Lords Financial Services Regulation Committee that he's beginning to see flashing warning signs, what used to be called slicing and dicing and tranching of loan structures. They are the ones we talked about earlier. He said massive alarm bells are going off. Everyone needs to take this very seriously. This is a canary in the coal mine, the stuff that we are seeing at the moment. JP Morgan also said a stock market bubble could be about to burst. He said he sees a serious correction in the next 6 months to 2 years. Everyone should be aware of it. But he did say these are common. What does Warren Buffett say about them? It's washing out all the trash, as it were. And that tends to be what happens. It washes out all the bad debt. We got a couple of, in fact, we talked about these already. I showed you these. Consumer, here we go. Here's another couple images for you. So this is the gap between the consumer financial situation and the S&P 500. It has inverted now. We've just had sort of announcement that monthly jobs report, unemployment rate, CPI, all these things are not going to be coming out. There's a blackout due to the government funding or lack of funding. Japan's 10-year yield is approaching its highest level since the run-up to the GFC as well. And we've also had the repo surging by 50 billion. This tells us, ladies and gents, that there's a lot of issues coming. Check out the webinar anyway. It will help you out with handling a lot of this. Apart from that, take care. God bless. I'll see you on the next one.